Hello and welcome to this episode of Africa's Big Switch. Today we'll be speaking to Collins Koindwa, who is a senior investment analyst at SunFunder on the topic financing energy access in Africa. My name is Bolaji Akinlali, and co-hosting with me are
Nadia Ademi and
Daniel Bonner.
So let's kick off with an introduction to Collins. Hi Collins, would you mind telling us a bit about yourself and your background?
Sure. Hi, Bolaji. Hi, Demi. Hi, Daniel. It's a pleasure to be on this podcast. My name is Collins Koindwa. I work for a company called SunFunder. At SunFunder, we focus on providing debt capital to energy projects and companies across the sub-Saharan Africa. We do this across different mediums. So we focus on the off-grid solar component. We focus on mini-grids, commercial and industrial solar, telco solarization, and the agri-solar market. And it's a pleasure to be here. My background is in financial economics, and I have been born and raised in Kenya.
You mentioned debt capital. What is debt capital, and what are the other types of investment in energy access?
Sure. I'm just happy to walk you through that. So debt capital is the equivalent of a loan. So we in layman terms, we provide loans to energy companies and projects. So the idea is it's a fixed capital component that then has to be repaid back over time, over different tenors. And it has an interest component attached to it. So is capital provided initially, and the company slowly pays off that capital with a principal component and a debt component. And we do this for solar energy companies across Africa. So that's the definition of debt. However, in the energy space in Africa, all forms of financing exist, right? And I'm going to take it from the top, where there is equity capital provided. And equity capital here is funds that shareholders or owners of an institution provide to a project or a company, essentially used for expanding and growth of the company. This goes down across the line all the way to debt, where you get financiers for the company that you have to pay back. And so in between equity and debt, there are different stages of mezzanine capital, which sort of like has elements of equity and debt on either side. So across Africa, there is availability of financing through those different forms. The typical investors in Africa, so there's quite a bit of presence of development financial institutions. So these are the DFIs that invest in Africa. So the DFC, the Swede funds, the FMOs, basically large government money or investment money coming from governments either in the European or American region that are plugging money into here. There are also a few of commercially oriented investors as well. So these are impact fund investors like us, where we typically source our monies from the DFIs and catalyze or use that money to invest directly into the ground. Some mature projects also get financing from the typical banking sector. There is also quite a bit of players who are the corporate investors who, the large institutions such as Shell, who come in, and because they have an impact or sort of like an energy or renewable energy focus, they do come in and want to put in capital and invest directly as a corporate. So it ranges in terms of who the capital providers are in the space. With respect to the typical sort of like investment recipients we see in the market, typically what you'd see is this ranges from sort of like locals. So these are African locals whose focus are to sort of like improve the renewable energy space. There is a bit of expatriates or sort of like foreigners who come in, and their idea is always to try and see if they can impact knowledge and sort of like experience gathered in other markets and be able to develop the renewable energy space in ours as well. And what we look at, or who typically receives these funds, are the guys with track record. So we look at track record, we look at experience. What have you done before? We look at technical expertise and knowledge. That's a comfort we get when investing in this type of companies. And as I mentioned earlier, obviously the renewable energy space has quite a bit of, there is wind, there is solar, the various types of renewable energies, but the focus for SunFunder is particularly solar. And in the solar space, we have on-grid solar. On-grid solar typically, or utility scale solar, is solar that where the off-taker is usually the government. So you create a project and then you sell power to the government. As SunFunder, we do not focus in that. What we do focus in is off-grid solar access. So this is solar that the off-taker typically is in the government. And in that field, the various areas where we go into. So there's the solar home systems, where you find it's a company that provides sort of like units that are purchased by individual families or homes, and they can get that energy powered by solar. So it's typically a few bulbs here and there and a charging system for the phone. Some of them, we're seeing them advance into having TV sets. There's the mini grids, where a solar system is then installed for an entire village. We also have commercial and industrial solar, and we're seeing this really pick up all across Africa. And typically, this is solar that replaces energy provided by the grid. So given how the cost of solar has been declining, there is opportunities across Africa to replace the grid energy with solar energy, and it's often cheaper and cleaner. So this is typically to manufacturing companies, the hospitality sector, which are hotels, etc., and also to sort of like schools and institutions that rely on this power. Then another thing that's been kicking in of late is telco solarization, and this is providing energy to the telecom towers. And the idea is typically these telecom towers, depending on their location, they had to rely either on grid connected power, but mostly on generators in order to run the power. So we're seeing a lot of energy service companies coming into the space and replacing that sort of like on-grid and generator power with solar panels. And then it assists in the renewable energy solar. Then the last one is agri-solar. So this is productive use solar, sort of like a solar-powered pump, water pump. So that's, brief introduction into the sector as I know it in sub-Saharan Africa.
Okay, I want to quickly say something. We just started learning like advanced debt finance and advanced equity finance in law school. And so my question for you was like, what made you want to work specifically in renewable debt financing? Because it's quite a technical area to be working in, especially in Africa, where there's already a culture of taking foreign loans. And so what made you want to work specifically in that area?
So the passion was just driven by making a change. So how the best way to make an impactful change with the skill set I had. Why particularly debt? Is because debt has an element of taking something for just in layman's terms, taking something that's already working and providing financing such to make it scale, right? So the ability to grow based on proven concept. Compared to equity capital, where equity capital comes in a bit earlier, and equity is usually used to prove that concept in most cases, not all cases. So the idea of scale is what attracted me to provide debt capital. It is slightly less complex than equity, although that's always relative, but the idea of scaling and looking at what works and being able to grow that is sort of like what drove me into not only the renewable space, but looking at a debt sort of like approach to growing the sector. So it is challenging, Demi, with respect to it does get complicated when you're looking at it sort of like in bringing several lenders together to finance a project. So there are projects that need enough capital to grow to that level. So, and then also with collateral, right? So another thing that usually comes with debt is collateral, and just understanding how you get collateral in the various markets is quite interesting and fun as well.
So yeah, I was just going to say, you were mentioning about how in terms of the investment recipients, you have both locally based people and sort of expatriates who come looking for an opportunity in Africa. And I was wondering, in terms of, you working with institutional investors, DFIs, trying to get finance, where do you think most of that appetite is in terms of project type? So is it more geared towards the solar home system market or more towards productive use or mini grids? I think, I'd be quite interested to know.
Sure. So my experience has been that capital is typically geared toward energy access, right? So there is interest in anything that allows energy access. So obviously, at the onset, we've seen quite a bit of capital flow towards the solar home systems. These are the SHS companies that provide really small units to the end users, right? Because this is one of the metrics, especially in African companies, where the cost of connecting sort of like little villages to the grid is typically high. We've seen various electrification agencies or the government agencies try and split and just understand where it makes most sense to focus in terms of that grid connection, vis-a-vis where it makes more sense to allow this SHS companies come in and provide that access to electricity directly. So there is that focus where a lot of these DFIs just want to see the African continent as a whole improve energy access, right? That's one. But of late, we've been seeing also a lot of focus with respect to the C&I solar space, where the idea here is now this company is already consuming electricity in one way or the other. But the idea is, can we make it more sustainable for them? Can they start consuming more green energy? Because then that has an impact in terms of the environment. So there is a lot of focus on those two spaces. Mini grids is sort of like a concept that there is a lot of attention to see the best way of making it work, especially from debt funding perspective. However, there is interest because the impact of a mini grid is completely good for a village. However, in terms of the ability for it to be investable from a project perspective, this is still being sort of like being tested and tried. And of course, there are a few people who say they've achieved that success, but we don't know where that yet. So it's kind of risky from a debt perspective, but we're seeing a lot of grants especially flow into that particular type of field.
From your experience, what are the main barriers and the risk to energy access investments? Because I know, like, so far you've mentioned, like, your company you work with, you deal with several clients, local expatriates, you deal with different focus areas from agri-solar to telcos. So from your experience, or from your point of view, what do you think are the main risks and barriers that kind of limits the energy access investments? You might want to tell us how it differs from different technologies as well, or from different clients.
Sure. Happy to do so. I guess one overarching risk element, depending, even if it's not respective of whatever sector or specific sector in the solar space you're looking at, is political risk, right? And I guess this is an overarching risk across all other investments. It doesn't have to be renewable energy only, but there is quite a bit of political risk here that I think is sort of like a barrier sometimes to investment. And here it's just around the effect that politics has on investment. And we've seen it over and over again where really large utility scale projects do not succeed because of a political element being played. So I'd put that as the first risk. Happy to discuss it further if need be. Second is in terms of policy, right? So I wouldn't say there is a bit of policy risk, but it's around governments being able to develop policies, not only develop, but also implement policies that support energy access. So this ranges everything from solar home systems to utility scale projects to C&I, sort of like commercial and industrial projects. And the idea is, can we have supporting policies in place such that projects that are being looked at are sort of like more investable or have a more investable impact? So that's a second risk, overarching risk I see across. Second, another risk we've been seeing around is also around currency with respect to some certain African countries where it's always a concern for any investor who's coming into a country and just understand how the currency risk is moving, what exactly is affecting those. There are some currencies that are pegged to the dollar, but do have alternative rates different from what their official rate is. How do you arrange for that? There is risk in terms of availability of currency, whereby you have the rate, but in terms of getting the actual dollars to pay back this foreign capital may be a bit risky. Then we have, for the utility scale projects, is also quite a bit of risk around the land regulations and laws, because it's a big factor that plays into the utility scale projects. So if I come back to policy, there is also sort of like things or incentives that can be put in place. For instance, how quickly is a PPA issued? What are the steps that you need to take to get a PPA in order to produce power? Is there a net metering policy in effect? So that's an added incentive whereby extra electricity produced can actually be utilized to sort of like can be sold back to the government and sort of like increase the revenue earning opportunity for the project. So overarching risks I see are there. But when you look at it, there is also governance in sub-Saharan Africa, how that is being done. There are things in place where, for example, to get a project in Kenya, you need to talk to the right person. And if you do not talk to the right person and sort of like agree, will your large utility scale project actually pass through? Yeah, I guess those are the main risks I see as challenges right now.
So I think there's one that you didn't mention, which I think there's dispute as to how much of a risk it is in different circles. But I guess, is there any kind of concern around also for the off-grid ones for off-taker risk and like credit risk with, given solar home systems? Because I know there's like, especially in Kenya, there's quite cool stuff being done to kind of address that. But yeah, so I was wondering, is credit risk an issue? And then I think linked to this idea of risk, you mentioned that for you, especially with debt financing, track record is really important. And I was wondering, does that kind of create a barrier for, say, locally based people who maybe don't have that, track record that they can bring in terms of them actually getting access to capital to create that track record? So I was wondering, those two risks there. What do you think? Very
excellent question, Daniel. And if you have me talking about off-taker risk, I can go on forever, right? That's sort of like my sweet spot. So yes, there is off-taker risk, right? And here I'd like to look at it in the sort of like, let's look at it in four aspects. So there is solar home system companies, the C&I solar, the mini grids, and the telco companies, right? Solar home system companies, there is off-taker risk. However, we've seen companies in this space develop credit criteria. So prior to, loaning these systems out or sort of like providing these systems on a higher purchase product, there's some credit tests and checks that are usually done to reduce this risk where everything is assessed from, the main sources of income, how you've been able to perform, what your intention is to pay, etc. They look at quite a bit of things before that loan is provided, but that's the first level. But what you've also seen with the SHS companies is at the end of the day, it's not the risk to an individual user is important to consider, but the most important thing is the portfolio risk, right? So it's a pool of different off-takers put into one bundle. And here sometimes you get tens to the thousands of customers, right? So you're looking at the portfolio risk, you're looking at the repayment patterns, you're looking at the incentive to pay to this sort of like clients, you're looking at their ability to go into the field and repossess the units should there be no repayments, and their ability to resell. So what we've seen is from a portfolio perspective, there are risk factors that then work that can allow for debt financing, right? So for argument's sake, for every 100 customers, there is a possibility that 10 will not pay to the full completion over time. But what we're seeing is like maybe 90 can get to that period over time. There is not only the risk of a default, but the risk of delayed payments and what then actually that means. Because maybe somebody is in a position to wants to pay but cannot pay at that point of time. So those various factors you look in SHS companies. So what we do look from a debt perspective is actually the portfolio risk and the company's track record in terms of issuing these systems to clients who eventually pay. So it's a big thing and it's aligned to track record. When we go to the C&I solar space, I guess the risk in terms of off-taker risk, a bit more work is given because it moves from a portfolio approach to sort of like a single entity, right? And here we do the credit check as if we were lending to the company directly, whereby we have to be comfortable with the company's historical financial performance. We have to be comfortable with the company's prospects, which are growth. So are they in a sector that will continually grow? But at the end of the day, it's sort of like de-risked by the fact that in most cases, these companies have been paying their electricity bill. And with implementing a solar project in these companies, we'd help them realize sort of like saving on their electricity bill, which means that the company has even more of an incentive to pay for this because it's actually a saving that is making. But for the C&I solar space, we look at the entity or the company at an individual level, and they have to pass the credit test in as if we were lending directly to the company. So that's a C&I solar space. For the telco solarization, we see these companies are usually the large telecom companies across Africa. So the Airtels, the Safaricom's, and from our credit risk perspective, they usually, when you compare it to the other sectors, the credit risk is a bit more, what's the word for it? It's a bit less risky profile because of how large these institutions are, the ability to get the revenue, the ability. So most of them are like on a cash basis. So we find that as a risk that there is a lot of appetite to take up. So there is that. And then lastly is the mini grids, where here you're looking at, and I guess mini grids, Bolaji, is a whole other sector that I think you may need a different podcast for.
You're right.
But yes, I don't want to really go into that. But the whole idea is power will be produced. Is there ability for the consumers, which are these households, is there ability for them to pay for this power? Not only ability to pay, is there a need for the power, right? So you install a system whereby the only power then is used to power a few light bulbs. Does it justify the cost of the mini grid? Will you eventually get repaid? And is there ability to sort of like de-risk that by ensuring or, by providing for businesses that can support the use of power that you've installed in these various villages? So the off-taker risk in mini grids is something I'm not an expert on, but I think it's sort of like a general topic that still we have quite a bit of learning to do. With respect to track record and experience, right? So for instance, the SHS, the track record and experience is mainly around creating a portfolio, and not only a portfolio or growing that portfolio over time, but making sure that that portfolio is also performing. And here you look at all metrics such as portfolio at risk. So how many customers haven't paid for the last 30 days? What's the percentage of those customers over the total portfolio? How many customers haven't paid over 90 days? What's that proportion over the entire portfolio? How are these numbers moving over time, right? So is it increasing over time? Is that 90 customers who haven't paid over 90 days, if it's 10% in over the 12 months where you're analyzing, is it on an upward trajectory? Is it on a downward trajectory? And that's a track record we look at SHS companies. With respect to C&I solar, it depends on where we come in terms of financing. Are we doing an equity release? So an equity release is typically where the developer has funded the project by themselves and are therefore looking to exit. So what's the track record? Has a project actually realized cash flows? Has the power been produced and have they actually been paid for the power produced? How long has this happened? Are we comfortable with that risk? Are we comfortable with the off-taker risk? So that's a track record. In terms of if we come prior to the project execution, where maybe we're finding construction of the project and maybe also over the life of the project, what has the developer done in the past? Have they done similar projects of similar sizes? Have they been able to do larger projects? Is this a fast sort of like, is this a new developer? Which takes me to the second question where you asked, what does then this mean for sort of like people who come into the sector, experts where they have this knowledge, they've implemented these projects in various markets vis-a-vis the locals who are still learning or trying to acquire that skill set. We can see that gap is slowly closing because there's a lot of knowledge transfer. However, from a debt perspective, it's extremely difficult to finance these projects if there is no track record or experience, right? And I do have a saying where I'm like, you start a company, who's going to fund you fast? It's the triple F. So you first get your experience, you get funding from family, friends, and fools, right? So those are the initial people who'd fund you. Once you then grow a bit, then you can go get some funding to, further enhance your experience to angel investors or etc. The field of people who come in really early. Then that capital should help you grow to a point whereby an equity investor can come in and take quite a bit of stake, take the risk on you. Only once you prove that concept and develop the track record, then a financier from a debt perspective can come in and take over. So it is kind of balanced where initially it's very hard from a debt perspective to fund, projects without any track record or companies without any track record.
Great, but hope is not lost, right? Because you're still in business. So you mentioned a lot of really, really important things there. I feel like after this conversation, I might be a risk specialist, especially when you went through the list. You mentioned the currency risk, land regulation and laws, and policy risk. Obviously, you can't plan for 100%, but how can you limit the impacts of, let's say, rapid change in exchange rates? So let's start with the currency risk.
Sure. I'm happy to take that. There are various mechanisms in place to de-risk that, right? But I'm just going to start first. There is a risk that there is currency risk, right? Even when you're looking at, the larger sort of like governments or countries, there is always an element of currency risk. The idea from a risk perspective, what you look at is, can I, take that currency risk, right? So sometimes you analyze and the risk is present and you're just like, but it does make sense. You look at historically how the currency has moved in relation to the dollar, and you can make a case for, there's a case for let's take that risk and take it in. If the answer to it is yes, then well and good. If the answer is no, the idea is to come up with a mechanism. So we typically use hedges. So a hedge is whereby you provide your loan in a dollar rate. So for example, I'm going to use 10%. You want to offer this dollar rate and avoid sort of like to a local company. And this local company is making its revenues in Kenya shillings or whatever currency it is. The risk is the dollar rate will strengthen against the Kenya shillings such that over time, the company would require more and more Kenya shillings to purchase the equivalent unit of the dollar, right? So the idea is having a hedging provider come in and converting that sort of like foreign currency rate into a local currency rate. And through the hedging provider who you meet halfway is, as SunFunder, for example, will provide the loan in the dollar rate term. The hedging provider would take in the risk and provide the loan to the end user or the borrower in sort of local currency terms. So for instance, we would give at 10% rate, the hedging providers would do sort of the calculations in the back end and say, from a local currency perspective, to take on that risk will require the borrower to provide interest. They will be paying in Kenya shillings, but they will be paying us at a 16% rate. So they then take that risk. From our end, we receive 6% return on the loan. From their end, they receive 16% local currency rate. And we're able then to completely de-risk that by using a hedging provider, right? So the I think that's a way to explain it. Maybe not the best way to explain, but in terms of just trying to understand what the hedging provider does. And here there's various mechanisms the hedging provider has. So the hedging provider can use a series of swaps. There's ability to get into options. So there are various mechanisms that can be used to realize that hedging mechanism. Then lastly, is there something in between where, as lenders, we're also seeking to do where we can only take currency fluctuation up to a certain point. Hence, maybe we put a hedging trigger in place where the loan performs as is without a hedge. However, should certain metrics be hit, so for instance, should the exchange rate reach X and X is a place where now we are comfortable, then we get back to the borrower and say, now you need to put a hedge in place. That's sort of like how we handle the currencies risk in place right now. There are a lot of institutions that provide this hedging all the way from local banks into sort of like large DFIs and the MFX and TFX of the world.
Okay, so I have another question. So as a debt financer, obviously like due diligence is a really important part of your business. How have you overcome, I suppose, the unique barriers that come with trying to conduct due diligence in Africa, especially in such a new industry with new technologies and things like that, more on a local level than on the level of telcos? But how have you overcome that?
Sure. So yeah, due diligence is always a key thing that we have to get into. Right now, the idea is there is sort of like different aspects of due diligence. There is commercial due diligence where you look at the company and the operations and how it's running and whether it makes sense and whether they have prospects. There is financial due diligence where you're just basically look at the feasibility of whatever you're financing. Does it make sense? You're also looking at historically how they performed. There is legal due diligence where you need to make checks that everything makes sense. From company, they don't have sort of like any ongoing or threatening court cases that would impact the funding. You're also looking at the security you're going to take or whether it's actually allowable as a foreign investor to invest into the local entity. There is tax due diligence where you have to make sure everything is okay from a tax perspective. And then lastly, there is technical due diligence where you have, so in the case of a commercial and industrial solar plant, you have to make sure that the plans as proposed by the EPC, which is an engineering, procurement, or construction firm, or the developer themselves, do make sense and they've looked at all of the various factors, right? So clearly in doing the due diligence is important because we have to get a taste and feel at each of these levels. We do it twofold where one, we rely on information we've received from the client. That's usually the first, and whether it makes sense or not. Two, there is the ability to now counter-check that information by doing on-site due diligence visits, right? So here you're visiting the people of the company just to sort of like put a check on what we received and what we are told is actually what's happening on the ground, right? So the on-site due diligence is important to confirm what has been received. And then it's also very important from the technical perspective, especially if they have already ongoing projects on the ground. It'd be good to visit and make sure what they've installed makes sense and is working. And then lastly, I guess it's something that's built over time. It's just around your market knowledge, right? Whether from a perspective, does this work? Does this not work? Based on our experience, is this going the right way or is this going the wrong way? And there are different factors where we go into due diligence where the deal team that's doing the transaction does the due diligence, but it's verified at different stages. And, that's why we go from maybe having 3 or 4 levels of approvals where you first have something, an internal check, whether it makes sense or not. You ask for more information, and based on the high-level information, you get an approval to proceed into full due diligence. Then you have your investment committees or your credit committees as an extra additional check to everything makes sense and we've asked all the right questions or the deal team has covered all the aspects based on the experience so far. So yes, that's how it's currently done. Obviously, it's a bit of a struggle given the ongoing pandemic, whereby doing the actual site visits has been a bit difficult. But, there are various ways around it in today's world. There's one whereby, from a very realistic perspective, there's customers you've already done due diligence for, then therefore you have a bit of room to, just accept what they've given you is true. And there is the ability to hire technical experts on the ground in the various countries to perform that due diligence on your behalf. Obviously, we've as always, you try and be as creative as possible. So we even explored the idea of having drones, right? And, flying drones just to make sure that what you're seeing is exactly what you're being told. But there is quite a lot of due diligence being done like this over Zoom and over the call, and just having to rely on that, and maybe putting it as, once a loan is closed and, the countries open up, then you go for an actual site due diligence thereafter.
Okay, so I guess maybe just two very quick questions for us to wrap. The first one I was going to ask is, you seem quite passionate about the space, and I'm sure that passion, there must be some optimism about the future. So I think it'd be nice to hear what you're optimistic about for the future of financing energy access and just energy maybe in general in Africa when we eventually get past the access barrier. And then one question which we like to ask all our guests, which is more of a fun one, is if you could have an all expense paid trip anywhere in Africa, where would you go? And maybe somewhere outside of Kenya, because we have had Kenya in previous episodes, but where would you go?
Okay, so to answer in terms of the future and where I see it, so there is quite a lot of potential, right? Twofold. One, in not only providing energy access to those who don't have already. So that's quite a big market by itself, and quite a big gap that I think we as Africans have the responsibility to assist in filling. But two, there's also having the ability to convert the current energy users and make them green, make them renewable, make them more sustainable, which has an impact with respect to the environment and our future as human beings, right? So in terms of where I see it growing, there is so much potential. I was reading earlier today where they're saying between, I think, 2011 to 2019, the cost of solar has dropped by 77%, right? And it's only expected to keep dropping, which means is this renewable source of power will eventually be the cheapest power to use, and it has the best impact, right? So there is the ability. So from a cost perspective, which is sort of like the supply side, and from the demand side as well, it's sort of like all matching up to give us the opportunity to keep growing this. So there is a lot of opportunity for us to sort of like grow this particular sector. And I've never been to Nigeria. Hopefully one day I'll be. But I always hear stories where in Nigeria there is a lot of potential for solar, because in the city center or wherever, you never lack or never miss to hear the sound of an engine generator generating power, right? So just from that aspect, we still have a big gap to fill before we can say, we're comfortable from that space. So I see enormous amounts of growth, etc., just in the solar space. Mind you, we haven't discussed hydro, we haven't discussed gas and all the other renewable energy things we can utilize as well in the African continent. So that's where I see it. And I think Africa is strategically placed where solar just does make sense for Africa. So I'm just hoping to see more of that materialize. Where would I go? Twofold again. I've told my girlfriend that hopefully before we get married or have kids, we do need to take Kenya, South Africa, or Cape Town drive, right? So basically drive across all the countries between Kenya and Cape Town and enjoy the different sites, go see the 14 Falls, go through Tanzania, just basically do that drive. But I guess that's overreaching. If there was only one country I think I'd want to visit, it would be Morocco, just because of, I think, the culture that's there, and it looks like a fun place to go.
Also a very exciting space for solar. So I mean, it's going to be a leisure vacation, not work. But okay, cool. Well, thank you very much for joining us today, Collins. I don't know if any of my co-hosts have any closing remarks, but I think it was a pleasure to have you on the podcast. Thank you.